Today, expect more shock and awe from central banks. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In this week's market update, it's all about inflation and rising interest rates as central banks up the ante to try to put the inflation genie back into the bottle. A genie created by years of loose monetary policy, money creation and low rates. And the blunt lever of interest rates will create collateral damage to many as the more recent supply chain disruptions further amplify the inflation waves. So as normal, we'll start with the US, not least because of the powerful role that the US dollar plays globally, and then we'll traverse other markets and end up in Australia, where the RBA surprised many this past week with a 50 basis point rate hike, with more to come. And in passing, we'll also touch on gold, commodities and crypto. But first to the US, where stocks tumbled with the Dow falling 880 points in New York. That was because of faster than expected inflation, and it opens the door wider to higher interest rates. The volatility index leapt more than 6% to 2775. The consumer price index increased 8.6% from a year earlier in a broad-based advance, according to the data from the Labour Department. The widely followed inflation gauge rose 1% from a month earlier, topping all estimates. Shelter, food and gas were the largest contributors. The so-called core CPI, which strips out the more volatile food and energy components, rose 0.6% from the prior month and is 6% from a year ago. That's also above forecasts. Damage to market valuations caused by another bad inflation surprise, and what it implies for a late Fed and rising recession risk is not limited to one more difficult day for stocks, Mohammed El-Arin said in a tweet. Inflation came in above expectations, and markets reacted by ratcheting up their expectations for rate hikes, TD Securities said. Financial markets have now priced in 3 consecutive 50 basis point hikes, starting with next week's policy committee decision. And TD also said ugly seems like an appropriate epithet for May's CPI print. Energy prices pushed the headline print to a new 40-year high. Since May, the nationwide average retail gasoline price has continued to rise and is likely to reach $5 per gallon in the coming days. This will keep the headline reading elevated into June. And food prices also continue to accelerate, adding to the headline print. In fact, grocery prices rose 11.9% annually. That's the most since 1979, while electricity increased 12%, the most since August 2006. And rent of primary residences climbed 5.2% from a year earlier. That's the most since 1987. So there are growing risks that price pressures in these categories will continue to build. Russia's ongoing war in Ukraine, as well as stepped-up related sanctions, potential port disruption due to the upcoming West Coast dock worker contract expiration, COVID-related lockdowns in China and drought could all contribute to higher prices for food and energy. Tighter monetary policy will not help much with surging global commodity prices or structural changes in the way people spend and live in the post-pandemic world, Wells Fargo said in a recent note. That likely spells further trouble for President Joe Biden, whose approval rating has sunk to new lows ahead of midterm elections later this year. And while the job market remains a bright spot, decade-high inflation is crippling confidence among American people and largely is outpacing wages gains. Airfares rose 12.6% in May. That's a slight moderation from the prior month, but is still up the most on an annual basis since 1980. And prices for hotel stays, meanwhile, were up 22.2% year over year. Rising demand for travel and entertainment this summer, particularly among wealthier households who have the savings to support discretionary spending, as well as tight labour market conditions, will likely maintain upward pressure on services inflation in the coming months. So far, consumer spending has held firm in the face of inflation, supported by savings and credit cards, But some economists fear that the Fed will go too far in tightening policy, risking weaker spending. But shelter costs, which are the biggest services component and makes up about a third of the overall CPI index, rose 0.6% in April. That's the most since 2004 and is 5.5% up from last year. That's the most since 1991. And economists don't expect housing inflation to peak until later this year, suggesting further increases in these categories. Though used car prices, which had been cooling in recent months, advanced 1.8% in May, that's the most this year, and new vehicle prices climbed 1%. The yield on the US 10-year note rose 11 basis points to 3.165, and the 2-year yield was up to 3.06%. Traders now see a 50-50 odds of the Federal Reserve raising rates by 0.75 of a percentage point in July, while economists at Barclays and Jefferies said this move could come as early as next week. And former Treasury Secretary Lawrence Summers said that the Federal Reserve has failed to account for its mistakes and to realise the damage to its credibility after the last inflation data dashed hopes that a peak had been reached. It's pretty clear that peak inflation theory, like transitory theory, is kind of wrong, Summers said. The Fed's forecast from March, saying that inflation would come down to the twos by the end of the year, was frankly delusional when issued, and looks even more ridiculous today. Inflation-adjusted average hourly earnings fell 3% in May from a year earlier. That's the biggest drop since April 2021, and the 14th straight decline, according to other data released on Friday. That's killing consumer sentiment, which plunged in early June to the lowest on record, and inflation expectations moved higher. The University of Michigan's preliminary June sentiment index fell to 50.2 from 58.4, which is where it was in May. Consumer sentiment declined by 14% from May, continuing a downward trend over the last year and reaching its lowest recorded value comparable to the trough reached in the middle of the 1980 recession. All components of the sentiment index fell this month, with the steepest decline in the year ahead outlook to business conditions, which was down 24% from May. Consumers' assessments of their personal financial situation worsened by around 20%, and 46% of consumers attributed their negative views to inflation, up from 38% in May. This share was only exceeded once since 1981 during the Great Recession. Overall, gas prices weighed heavily on consumers, which was no surprise given that the 65-cent increase in national gas prices from last month. And half of all consumers spontaneously mentioned gas during their interviews, compared with 30% in May and only 13% a year ago. Consumers expect gas prices to continue to rise, a median of 25 cents over the next year, more than double the May reading, and the second highest since 2015. And in addition, a majority of consumers spontaneously mentioned supply shortages for the 9th consecutive month. So as a result of all this, the Dow on Friday suffered its biggest weekly sell down, slipping 2.73% to 31,392. The Nasdaq was down 3.52% to 11,340, and the S&P 500 fell 2.91% to 3,900. The financial sector was down 2.61% to 559.10. Treasury yields jumped on bets that the Fed will be forced to deliver 50 basis points at each of the next 3 meetings, putting growth sectors of the market, such as tech, which are vulnerable to rising rates, on the back foot. The dollar index, which pits the greenback against 6 other major currencies, hit a 3-week high of 104.15. And US bond yields, led by returns on the 10-year Treasury, hit a 1-month high. Apple was down more than 3%, while Meta Platforms and Microsoft fell 4%, leading the losses in big tech. Consumer discretionary also played a big role in the sell-off, led by travel and leisure stocks, on fears that red-hot inflation would put a further squeeze on consumer spending. Caesars Entertainment, Royal Caribbean, MGM Resorts, and Booking were among the biggest losers in the sector. The pace of consumer spending is going to slow. We've already seen that in the choices they are making, Chief Strategist at Sprouting Rock Asset Management, Reese Williams, said in an interview on Friday. There have been a few anecdotes that even on services like cruises, demand is down for next year. Williams added, people are a little bit shocked by how much things cost. Financials driven lower by banks as the Treasury yield curve continued to flatten on bets of a potential recession ahead. JP Morgan fell 4.6% to 119.55, while Wells Fargo fell 6.07% to 40.08. Signature Bank, Capital One Financial, and Synchrony Financial slumped, with the latter, which is sensitive to crypto, also suffering added pressure from a rout in the crypto sector. Oil prices skidded on Friday following the US inflation print, which sent the dollar flying, making commodities priced in the greenback, including crude, costlier for non-holders of the currency. But a barrel still held well above $120, ensuring a seventh straight weekly gain for US crude. The London-traded Brent settled down 1.06, or 0.9%, to 121.08 a barrel. For the week, though, it showed a gain of 1.8% and was up 9% over the 4-week period. The global crude benchmark is up 57% so far this year. West Texas Intermediate settled down 0.86% at 120.40 per barrel after a 3-month high of 123.15 on Wednesday. And for the week, the US crude benchmark rose 1.8% and was up 18% over a 7-week period. Year to date, WTI is up more than 60%. The average pump price of gasoline particularly has hit around $5 a gallon on Thursday for the first time ever in the United States. And analysts say that the Fed might have a tough task ahead as oil and gasoline prices don't seem to be coming down enough to stop inflation in its tracks. Oil prices did retreat on Friday as the return of new partial lockdowns in China raised fears of reduced demand from the world's largest crude importer. Shanghai imposed new mobility curbs on Thursday after China's latest economic hub recorded a cluster outbreak of COVID-19 just a week after the country's most populous city ended a prolonged lockdown. So the oil market is very tight, and the eventual weaker US consumer won't really take effect until closer to the end of the year, said Ed Moyer, analyst at online trading platform Onya. Some traders are entering de-risk mode as prospects for the economy continue to dim, but no one really wants to abandon the best trade of the year, which is oil and energy stocks. Now, of course, inflation is everywhere and gold bulls are lapping it up. US gold futures hit 4-week peaks on Friday as stocks on Wall Street took their worst beating in 3 weeks. Gold is supposed to be a hedge against inflation, and it typically rallies when investors become worried about a reduction in the purchasing power of the dollar. But it's not a perfect correlation, as gold has also broken down various times this year when inflation data came in higher. Further confounding the hedge theory, gold and the dollar have also rallied together on various occasions this year as inflation concerns propped up bullion prices, while the greenback rose on expectations of Fed rate hikes. That was the situation on Friday. Reacting to the various inflation data, front-month gold futures for August on New York's COMEX rallied to a 4-week high, just shy of $1,880 an ounce. It eventually settled at $1,875.45, up 1.21% on the day. And for the week, the benchmark gold futures contract was also up 1.2%. The initial shock of a scorching hot inflation report sent gold prices to fresh session lows as traders quickly bumped up Fed rate hike expectations for the September meeting, said Ed Moyer. Then the 5-year and 30-year Treasury yields inverted, and growth concerns triggered some safe haven flows for gold. Over in Europe, European stock markets weakened on Friday as investors digested the rate hike guidance from the European Central Bank and, of course, the key US inflation data. The DAX in Germany closed 3.08% lower at 13,761. The CAC 40 in France fell 2.69% to 6,187. And the UK's FTSE dropped 2.12% to 7,317 in the days following Boris Johnson's lukewarm vote for support from his party. The European Central Bank confirmed on Thursday that it's going to end its long-running bond buying scheme at the start of next month. and said it would raise rates by 25 basis points in July and again in September, potentially by a larger amount as it battles soaring inflation. Inflation in the Eurozone is now above 8%. And the ECB announced that it would cease net asset purchases on July 1. The possibility of a more aggressive hiking cycle later in the year is weighing on sentiment as the Eurozone economy struggles with slowing growth, exacerbated by the war in Ukraine, as well as rampant price increases. The revised growth outlook from the ECB echoed scaled-back forecasts from the World Bank and the OECD earlier in the week that have reignited fears of stagflation, a noxious combination of low growth and steep consumer price increases. We're seeing accelerating economic growth and persistent high inflation, said Gillard, head of global equities at Federated Hermes. The pandemic-induced supply chain shock and the Ukraine conflict are beyond the central bank's control. In this environment, we need to be lucky to avoid stagflation that could last for a long time. The euro-US dollar was down 0.91% to 1.0517, and the Deutsche Bundesbank on Friday slashed its German growth forecast for 2022 and the next 2 years, saying that the war in Ukraine and ongoing high inflation looks set to weigh on Europe's largest economy for the foreseeable future. Investors have been focused for months on how quickly central banks will try to normalise monetary policy to curb inflation, and in corporate news, Credit Suisse stocks fell 5.7% after State Street stated late on Thursday that it was not looking to buy the embattled Swiss lender, its first outright dismissal of a news report that it was seeking a deal. GSK stocks rose 1.6% after the drug maker said its vaccine targeting a respiratory virus in older adults each year delivered positive results. It closed at 1,736.60. Asia-Pacific stocks were mostly down on Friday morning. Investors were digesting the European Central Bank's signal on future interest rate hikes ahead of US inflation data. Japan's Nikkei 225 closed 1.49% to 27,824, and South Korea's Kospi was down 1.13% to 2,595, while Hong Kong Hang Seng's index was down 0.29% to 21,806. Tech giants listed in Hong Kong plunged, with their sub-index opening 2.9% lower. China's Shanghai Composite closed up 1.42% though, following reports that parts of Shanghai will lock down this weekend for mass testing as COVID-19 cases continue to emerge. The news comes just 10 days after strict lockdowns across the Chinese city were lifted and sparked concerns about demand for commodities in the world's second largest economy. Data released earlier show that China's factory gate inflation cooled to its slowest pace in 14 months in May. The producer price index, the PPI, rose 6.4% year-on-year in May, while a rise of 8% was recorded in April. That was the weakest reading since March 2021. Cooling might be caused by weak demand for steel, aluminium, and other industrial commodities due to COVID-19 disruption on production. Meanwhile, the consumer price index rose 2.1% year-on-year. Now down here in Australia, Australian shares endured their worst week since 2020 as markets digested the fallout from the Reserve Bank's double rate hike surprise, which intensified a sell-off in the country's largest lenders. The S&P/ASX 200 fell 1.25% to 6,932, extending the weekly loss for the blue chip market to 4.2%. That's the biggest weekly tumble since April 2020 and one of the worst since the pandemic began. Steep weekly declines for Australian banks led the downdraft for local shares, with the financial sectors, which accounts for a third of the S&P/ASX 200 by market value, cratering 9% this week as the big four banks all fell. That was the worst week for the sector since March 2020. CBA, Australia's second largest listed company, Westpac, and NAB all ended the week in correction territory, marking a 10% drop from their June peak. And ANZ, which has the lowest market share of mortgages, shed 8.9% during the same period to 2307. The pain for the banks reflected investor concerns about the effects of tighter monetary policy from the RBA, which surprised economists and investors with that 50 basis point increase in the cash rate on Tuesday. Higher rates are expected to weigh on Australian property and in turn affecting lenders' mortgage books. Meanwhile, the resource sector, which had been a shining light amid the recent market volatility, retreated on Friday. Fortescue dropped 0.5% to 21.45, BHP edged 0.04% lower to 46.22, and Rio Tinto tumbled 1.3% to 115.90. The local technology sector tracked a weak lead from Wall Street as the prospect of rising interest rates weighed further on growth stocks. Block was among the market's biggest laggards on Friday, dropping 5.7% to 109.67. And of course, the ASX will be closed on Monday in observance of the Queen's birthday. Trading will resume on Tuesday. And finally, the hotter than expected CPI print resulted in a collapse below $30,000 support level for Bitcoin. And in fact, it went to a low of 28,852 before dip buyers managed to bid the price back above 29,000. It fell more than 2% to 29,225 at the last count, while Ethereum fell more than 6% to a 52-week low at one stage and was last at 1,674.30, down 5.79%. Now, many are watching to see if the largest coin, Bitcoin by market share, continues to slide, though calculations from on-chain analytics platform CryptoQuant said that miners' production prices, which is how much it costs to mine a single Bitcoin, could be right where the current spot price resides. While raw costs may be around $22,000 per Bitcoin mined in North America, which, by the way, is home to the lion's share of hashing power, additional costs could put the total at around $30,000 US. So they said we estimate cost basis for Bitcoin miners in North America could be around $22,000 per Bitcoin mined. This estimate includes the direct costs of mining and other expenses. It does not include depreciation and amortization charges. If depreciation and amortization charges were included, then the cost basis for mining Bitcoin is around $30,000, basically at the same level as the current Bitcoin price. So if it goes lower, then some say the fall could be significant. We will see. And also other altcoins, of course, continue with their bumpy old ride. So pretty much wherever you look, it's the same story. Inflation is out of control. Central banks are having to put rates up. Consumers are getting very twitchy. Confidence is dropping. And the financial sector and the tech sector are being hit quite badly. So expect markets to drop further from this point. And by the time we get to September, we could, I think, begin to see perhaps some bottom of some markets. But that's a long way to go. And I think there's still more to the downside from here, because we will expect to see more significant hikes in rates, shock and awe, in fact, from central banks. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.